So in our last class, we discussed how to estimate cost of preference shares. Today, we are going to be looking at cost of debt. Okay, this is what we want to achieve today. Let me put it down. So we are going to discuss cost of debt. Then we're also going to discuss cost of convertible. All right, cost of convertible securities. Okay. And then if time permits us, I will introduce you to weighted average cost of capital. So these are the three objectives that we want to achieve today. So let's take it one after the other. Like I said, please open to your material so that we can be speaking on the same page. I like to express myself. I don't want to be, that's why I don't want to display the study material or at your hand so you can be following. Just open it so that you can follow through. All right. So let's talk about cost of capital. Now, cost of debt. Before we dive
Onye
in
mbụ ya
into
agbanye aja na ya.
who is the person talking in my class, please mute, mute, everybody mute. You know the rule already. Thank you. If you want to ask any question, always raise your hand so that I don't distract. When I hear voice, suddenly it distracts me, it disrupts my flow. So I don't want that to happen. But once I see your hand, I can quickly allow you to speak. Thank you. Yes, before we talk about the the discussion for the day, in our last class, we discussed cost of preference share for the benefit of those that missed the last class. And we said that cost of preference share uh, represents the compensation paid to the providers of or to the preference shareholders for their investment in a company. And then cost of preference share uh, is as a preference shareholders are entitled to a fixed dividend from the business or from the company, and that the preference shareholders will be settled before the ordinary shareholders, but after the debt holders might have been settled in the event of a liquidation of a company. All right. Then we proceed to discussing the the, the kind of preference share. Um, we'll talk about irredeemable as well as the redeemable preference shares. We said irredeemable preference share is the one in which the company will pay annual fixed dividend, but the principal will never be repaid. All right. So every year the company is expected to pay fixed dividend to the preference shareholders to infinity, but the principal sum that the preference shareholders have invested in a company will never be repaid. All right. And we said that the cost of preference share will be computed as the cost of irredeemable preference share will be computed as the ratio of fixed dividend to ex-div share price. Anytime you want to calculate cost of irredeemable preference share, all you need to do is to divide the fixed dividend we divide it with the ex-div share price. That is, ex-div share price means that the share price, the preference share price that that exclude dividend. Because when you want to calculate cost of preference share, you need the share price that exclude dividend. And not only that, we said that the preference the preference dividend is constant. It's not going to change. It doesn't grow. It will remain the same for the period for the period okay of the investment. It's not going to change at all. That's why you said it's fixed in nature. All right. As the name implies, fixed dividend. Okay. Now, not only that, I also said that the preference share. Okay, the nominal value of the preference share is usually 1 naira. Okay, the nominal value per share of the preference share is usually 1 naira. And then the fixed dividend that the preference shareholder will earn from the business is a nominal rate. So that nominal rate, you are supposed to apply it on the nominal value, all right, to get the fixed dividend, okay? And we also demonstrated that. Then we move to discussing cost of redeemable preference share. We say redeemable preference share is a kind of preference share whereby the company is expected to pay annual fixed dividend as well as the principal at the maturity date. All right. When the preference share matures, the company is expected to redeem, is expected to pay the principal sum to the preference shareholders. All right. So every year the company will be paying fixed dividend until the maturity date, when the company will pay the dividend, the fixed dividend for that maturity date, then plus the principal repayment. This is redeemable preference share. And we said that redeemable preference share is computed as internal rate of return, meaning that anytime you want to calculate redeemable preference share, you are expected to calculate internal rate of return. How do you calculate internal rate of return? Just assume two discount rates that will produce two opposing NPV. One discount rate will produce a negative NPV, then you reduce the discount rate to get in a positive NPV. Then you interpolate into the IRR formula to get the cost of redeemable preference shares. All right. I think that's what we did in our last class. So today we are going to start with cost of debt. So within the next 30 minutes or thereabout, we should be able to complete this. Let's talk about cost of debt. Let me know in case you have any question for me based on what we did in our last class, so that I can quickly put a kind of a clarification before we proceed. If you have any question based on our last class, let me know. If not, then we proceed. All right. So let's talk about cost of debt. Now, the cost of debt represents the compensation required by the providers of debt capital in a company. I repeat, cost of debt represents the compensation required by the providers of debt capital. It's also known as cost of debt finance, okay? Cost of debt finance, all right? When a company borrows loans, all right, to finance its operation, so that loan is not for free. The interest that is attached to the loan is the cost of debt. Therefore, the debt holders are expected to receive fixed interest from the company, all right, as a result of investing, as a result of borrowing or advancing loan to the company, all right. So they are entitled to fixed fixed interest in the business, all right. So the debt holder, in the event of liquidation of a company, the debt holders will be settled, will be paid before the preference shareholders as well as the ordinary shareholders. Generally, debt is considered to be a cheaper source of financing because of tax deductibility benefits. I take it again. Generally, debt is considered to be a cheaper source of financing because of tax deductibility benefits. So when a company finances operation with debt capital and then there is tax, so the company is expected to pay a lower cost, all right, as a result of tax benefits. But when there is no tax, the cost will be high relative to when there is tax. All right. So usually there are irredeemable, okay, there are irredeemable or redeemable debts, callable or non-callable debts. Okay, let me put it, callable or non-callable. They are similar, redeemable and irredeemable, callable and non-callable. They are similar, but there is a slight difference between the two. But our focus is on the redeemable and then irredeemable. So let's talk about, before we move to talking about redeemable or irredeemable, let me give you two types of debt. so that you can understand the perspective we are going when we are calculating cost of debt. Okay, so there are basically two types of debts. Let me write it. Types of debt. Number one, we have traded debts. Then two, there is non-traded debt. So what do you mean by traded debt? Let me put it down. Traded debts. These are fixed income security. These are fixed income securities. Okay. Including bonds, debenture, and loan notes. That are tradable or that can be bought or sold in an organized financial market. Loan notes that can be bought or sold in an organized financial market. Okay. So this is what is known as traded debts. So the traded debts are fixed income security that are tradable or can be traded in an organized financial market. You can example of traded debt are bonds, debenture, and loan notes. These are long-term source of finance. Okay, so you can go to the market and buy bonds, debenture, or loan notes. You can also sell it when you need money. When the company needs liquidity, they can dispose of the bonds and get money in return to be able to, when the need arise, you know. But of course, this is in case you are asked, what do you mean by traded debt? I just give it to you. Abutu, are you just joining this class? Carry the you to mute, please. Please kindly mute. Thank you. Carry your speaker is still on mute. So let's move on. So we are going to learn more about bonds. Under, I think it's under the scope. I'm not sure. It's still there. Yeah, it's still there in SFM. Yeah. So Mr. Shuaju will teach you as per bond valuation and analysis. All right. So you will learn more about the characteristics of bond, how to value bonds, and all of that. Okay. All right. So let's talk about non-traded debts. Non-traded debts. These are securities. These are securities that is not tradable. That is not tradable in an organized financial market. Okay. Examples include, let me ask you. Yes, who can tell us? Give me one example of non-traded debts. If you know it, raise your hand. Minister of Finance, go ahead.
Bank overdraft.
Bank overdraft. Okay, thank you. You are correct. Overdraft is an example of non-traded debt. Yes, who again? Yes. Another example of non-traded debt. Who wants to try? Okay, bank overdraft, and a bank loan. Bank loan. These are examples of non-traded debt. You cannot take your bank loan to the market to say you want to sell it or you want to buy it. It's not tradable. All right? It's not tradable. You can't buy, you can as well not sell it in the market. Okay, these are examples of non-traded debt. So of course, the cost of non-traded debt is usually calculated as irredeemable. This is a kind of, you calculate it as when you want to calculate after-tax cost of debt. All right, interest multiplied by 1 minus tax. Okay, so that's basically the two types of debt. Then let's talk about irredeemable as well as a redeemable debt. All right. So cost of irredeemable debt. The irredeemable debt is a kind of debt whereby the company is expected to, have I told you that before? Have I explained irredeemable debt? Talk to
Yes,
me.
sir.
Please
No,
go
Yes,
over
sir.
it again.
Oh, pardon? What did you say? I didn't get you.
Please
You have
go
Have I
over
explained
it
now.
explained?
again.
I've explained irredeemable debt, right? Okay,
I
let me
said,
quickly
but you can go
recap.
over it again.
Now, okay, so irredeemable debt is a kind of debt whereby the company is expected to pay annual fixed interest, but the principal will not be repaid. All right. So every year the company is expected to pay annual fixed interest, but the principal will never be repaid. All right. So the cost of charity, simple instruction. I don't want to just mute yourself. Just mute, please. So the cost of irredeemable debt is computed as the ratio of fixed interest to X int price, depending on whether there is tax or not. Let me just put it down. Okay? Irredeemable debt. Irredeemable debt is the one in which the company is expected to pay annual fixed interest but the principal will not be repaid. Okay. So the cost of irredeemable debts, the cost of irredeemable debts is computed. Okay, or let me just put it, the cost of irredeemable debts represents, before I talk about how to calculate it, represents the ratio of fixed interest to X interest price. Okay, depending on whether depending on whether or not there is tax. All right. This is calculated as follows. This can be calculated using the formula below. Okay. So whenever you want to calculate cost of irredeemable debt, then of course KD, that is cost of debt, cost of irredeemable debt, is calculated as fixed interest divided by X interest price multiplied by 100 over 1. This formula is used where there is no tax. This is used where there is no tax. Okay, that's when you use this formula.
Sir? Okay, sir.
Who is speaking? I told you to raise hand if you want to talk. Sanusi, Yusuf, go ahead.
Sorry, sir. Sorry, sir.
Oh, okay. You didn't intend to. It's all right. Yes, so this is the formula for calculating cost of irredeemable debts when there is no tax. But where there is tax, then KD will be calculated as fixed interest multiplied by 1 minus tax divided by X int price. Multiplied by 100 over 1. So you use this formula where there is tax. Okay, see the difference between the two. So you remember what I told you earlier today? Debt is a cheaper source of financing because of tax deductibility benefits. Whenever there is tax, the cost that the company will pay to the debt holders will be lower relative to when there is no tax. All right? Okay, so that's basically that. One thing you need to know before we solve question, notes. Debt is usually quoted at 100 naira per unit. Debt is usually quoted at 100 naira per unit.
Please, can you take the board
Okay,
up? Don't copy the formula for tax.
except examiner says otherwise. Okay, so in a question, when you want to calculate debt, examiner will not tell you it is at 100 naira, except you are lucky. But if examiner wants you to use another figure, maybe 1,000, it could be 1,000 or it could be 100 naira or 1,000. But in most cases, it is 100 naira. All right. If examiner wants you to use 1,000, you are going to be told. But again, in most cases, you are not going to see it in the question. But it is implied that you know it, that debt is always quoted at 100 naira per unit. All right. So that is as per that. When we get to redeemable debt, I will tell you what you should look out for. So at this point, let's have our illustration, the short examples to demonstrate the concept. All right. I will stop sharing this. Yeah, somebody talked the other time that I should scroll up, and I've done that. I don't know. Can I switch? The person that wanted to copy
Yes,
formula.
thank you.
Okay, then. So let's have illustration. Okay. Let me see. So let's try illustration number 6. Aberdeen PLC. Who is helping us to read it? Aberdeen. Okay. Who is helping us to read? Okay, let me go ahead. Yes. Aberdeen PLC is financed with 10 million 9% redeemable debenture quoted at 102 naira. Interest on debenture was paid last week. What is the cost of debenture if the company is not liable to pay tax? 2, the company tax rate is 40%. So here examiner is asking you to calculate cost of debenture if the company is not liable to pay tax. When you look at this question, you will see that examiner mentioned 9% redeemable debenture. So, of course, for a redeemable debenture, a debenture or a debt to be redeemable if a redemption date is given. So in this particular question, you are not given when the debenture will be redeemed. Therefore, you are going to calculate it as cost of irredeemable debenture, because when in the future that the company will redeem, the debenture is not given. You are not given the maturity date. So as a result of that, you cannot calculate cost of redeemable debenture. It has to be irredeemable. All right. So how do you then calculate cost of irredeemable debenture? I told you the cost of irredeemable debenture or cost of irredeemable debt is the ratio of fixed interest to exchange price, depending on whether there is tax, whether or not there is tax. So in this particular question, you are given information as to where there is no tax and where there is tax. So let's demonstrate the two and see how it will look like. All right. So to solve this question, before we should be able to manage this space to solve it, no need to switch. All right. Let me just see. Now, the name of the company is Aberdeen. So to solve this, okay, let me just, let me switch. I don't want to be managing space. All right. So solution or example, solution to illustration, I think that's illustration number 6. Yes, Aberdeen PLC. Solution to illustration number 6. Page 29. All right. So you are asked to calculate cost of debenture. I would then say Aberdeen PLC calculating cost of irredeemable. We have identified from the question that this is not a redeemable debenture. So it is irredeemable. So you can see that in the question, examiner did not ask you to calculate. you are not asked to calculate irredeemable debenture or redeemable debenture. You are just asked to calculate debenture, cost of debenture. So you should be able to identify from the question which one is this redeemable or irredeemable. It should be redeemable if the redemption date, that is the maturity date, is given. But if the maturity date is not given, you are going to calculate as cost of irredeemable debenture, just like the way we are doing. So the cost of irredeemable debenture, where there is no tax, examiner says where there is no tax, put it down. Number 1, where there is no tax. Okay. Where there is no tax, cost of irredeemable debenture will be computed as the fixed interest divided by X int price. Now, there's something I did not tell you when I was giving the notes. You know, in relation to X int price and cum int price. When you talk about the same way we discussed the concepts under cost of equity and cost of debt in relation to XDIV and cum div, the same thing applies there. When you talk about cum int price, the cum int price represents, let me put it down so that it is written boldly. Let me look for a space to put it down. Okay. Let me just write it somewhere. The cum int price. Okay, let me use your. This is not part of your solution. I just want to put a note there. Note, the cum int price okay, is the market price. Is the market price of debts. Market price of the debts that include interest. So the cum int price is not used. The cum int price is not used for calculating cost of debts. Okay, for calculating cost of debts. Okay. So if cum int price is given, it should be converted to X int price. If cum int price is given, it should be converted to X int price. Okay, should be converted to X int price. So that is that. I believe that is clear. Now let's continue with our solution. So KD will then be equal to, I will go back to the question. What's the interest rate given to us? According to the question, we are told that 9% redeemable debenture. That 9%, the interest rate or the coupon rate is usually attached to the value of the debt. The value of the debt, the nominal value of the debt is 10 million naira. So the 9% is the interest rate that the debt holders will earn from their investment of 10 million naira in the business. So 9% is the interest. So you are not going to use 9%. You are not going to use 0.09 because debt is always quoted at 100 naira per unit. So when you multiply 9% of 100 naira, you are going to get 9. So always remove the percentage behind the interest rate. So you use the value just as it is. That is 9. Then, of course, in this particular question, the market price of the debenture is 102 naira. The market price of the debenture is 102 naira, and you are told that interest on debenture was paid last week. So, which means that the market price of the debenture of 102 naira already exclude interest. So, there's no need for you to make any adjustment. So, in this case, the cost of irredeemable debenture when there is no tax will be equal to 9 divided by 102 multiplied by 100%. All right, so let's put it down. So this will be 9 divided by 102 multiplied by 100 over 1. So this will give us approximately 9%. So the cost of irredeemable debenture where there is no tax is equal to approximately 9%. Okay. Then number 2, high. Where there is tax. Where there is tax. Or where company tax rate is 40%. Where company tax rate is 40%. So you have been given a tax rate of 40%. Now that we have tax, how do you compute your cost of irredeemable debts? So KD will then be equal to fixed interest multiplied by 1 minus tax rates divided by X int price multiplied by 100 over 1. So KD will then be equal to interest is 9%, which is 9. All right. Multiplied by tax rate is 40%. So 1 minus 0.40 divided by market price of the debenture, which is 102 naira, all multiplied by 100 over 1. So our KD will then be equal to 9 multiplied by 0.6. What do you have? Wumi? Are you still there?
5.4, sir.
5.4. Therefore,
5.4.
5.4 divided by 102 multiplied by 100%. Give it to me.
5%.
5%. All right. This is approximately 5%. You know, I told you earlier that debt is a cheaper source of financing because of tax benefits, because of tax relief. You will notice that when there was no tax, the cost
I'm
of
going to check cash. Maybe I like 5,000.
Kayode Akinbowale, you are disrupting my class. So I told you earlier that debt is a cheaper source of financing. You will notice that when there was no tax, the company is expected to pay 9% to the debenture holders. But where there is tax, it's okay. Okay, it's all right. So where there is tax, the cost that the company will pay to the debt holders is 5%. So the cost has reduced as a result of tax benefit. So that's why we are saying that debt is a cheaper source of financing because of tax benefits. All right. So let's move on to the next one. Let's have another example. So do you have any question on this before I switch? Okay, so let's move on. Yes. Let's have illustration number 7. Illustration number 7. Jonato PLC has 11% irredeemable debenture of 5 million naira in its capital structure, which currently yields 8%. Required. Determine the value of the company's debenture. You have to be very careful. Can you quickly, somebody is asking question. Can you quickly tell me why 9% becomes fixed interest? Is that in the question? You are told that Aberdeen PLC is financed with 10%, sorry, with 10 million, 9% redeemable debenture. That I've told you already that the coupon rate is the same thing as interest rates. The coupon rate is usually attached to the value of the debt, attached with the nominal value of the debt. The nominal value of this debenture is 10 million naira. So what will follow is the interest rate of 9%. All right. So examiner is not a process that examiner must tell you that the interest rate is 9% or 5%. So it is implied in the question that you know it. All right. So that 9% is the interest rate. I believe that is clear. Olumide, am I good to go?
Okay, sir.
Okay.
Thank you very much, sir. Yes, sir.
All right. All right. Gerard, Chinoso, please mute. Let's move on. Now, how do you then solve this particular question? Illustration number 7. Examiner is asking, you have to be very careful. The examiner is asking you to calculate the value of the company's debenture. This is not cost of capital. You are not asked to calculate cost of capital. You have to determine the value, the market value of the debenture. Therefore, how do you compute market value of debenture? Let me show you. I will stop sharing this and move to the working notes. So we are at illustration number 7. So still on page, I think page 29 or thereabouts. Let me confirm.
That's correct, sir.
Thank you. Page 29. Jonato. PLC. So examiner is asking us to calculate unit value of the debenture. So I would then say calculating the unit value of debenture. Now, before you be able to do this, you need to understand, before we solve this question, you need to understand what is market value of debt. All right? What is market value of debt? So how do you compute the market value of debt? All right. So when we get to work, I'll be talking more about how to calculate market value of equity, market value of preference share, and the market value of debt. But for now, for the purpose of this question, let me just put it down for you. This one relates to debenture. So we have to calculate market value of debenture. All right. So the market value of debenture, the market value of debenture. Now, first thing first, you need to know what kind of debenture is this one? Is this a redeemable or irredeemable? According to the question, is irredeemable debenture. So I would then say the market value of irredeemable debenture represents the present value, of the expected future cash flow. Represent the present value of the expected future cash flow. That is the cash flow we are talking about, that the cash flow that the debenture holders are expected to earn, because this is irredeemable. Remember, I said irredeemable debt is the one in which the company will pay annual fixed interest, but the principal will not be repaid. So that fixed interest that the company will pay to the debenture holders is the future cash flow. That is fixed interest discounted discounted at the yield at the cost of debt, discounted at the cost of debt, or yield, you can call it yield. Internal rate of return is the same thing as yield. All right. So discounted at the cost of debt or yield. Okay. So it is computed. Let me put it down for you. The value of irredeemable debts, the value of irredeemable debts irredeemable debt or debenture is calculated as the ratio of fixed interest, to the yield or cost of debt, depending on whether or not there is tax. All right. So this is how to calculate the market value of irredeemable debt. So for the purpose of this, I would then say market value of the debt is calculated as fixed interest. In the question, we are not given anything like tax. So it will be fixed interest divided by the yield or the cost of the debt. According to the question, we are told that the yield is 8%. Then the interest is 11%. Okay, we are told that Jonato PSC has 11% irredeemable debenture of 5 million naira in its capital structure, which currently yield 8%. So that 11% is the interest rate, is the coupon rate attached to the nominal value of 5 million naira. The yield is 8%. Therefore, this will be, since there is no tax, the market value of this debenture will be equal to 11 divided by 0.8. Okay? Let me put it down. Divided by the yield.
Sorry, sir. You said 11 divided by 0.8. Shouldn't be 11% over 8%.
I said, if you want to talk, always raise your hand. Don't cut me unexpected. It distracts me. So always raise your hand and I will allow you to talk. But you have already talked, so go ahead. Timileyin.
Sorry, so you were saying
Timileyin,
that
go ahead.
you said that the market value of debt will be 11 over 0.8. I just wanted to clarify.
You can get closer to the speaker. I can barely
Sorry,
hear you.
can you hear me now?
It's better.
Yeah, so you said that the market
Yes.
value of debt would be 11 over 0.8. Or would
Yes.
it be 11% over 8%?
Okay. So just watch the way we are doing it now. All right.
Okay.
Is it okay, Timmy? So this is the formula for calculating the market value of the irredeemable debt or debenture, as the case may be. Now, from the formula, fixed interest divided by the yield, because in this question we are not given tax. Therefore, I will then go to the question, what's the interest rate given to us? According to the question, the coupon rate is 11%. So you are given 11% coupon rate. And I told you that always forget the percentage attached to the interest rates. Forget about the percentage because debt is always quoted at 100 naira per unit. Ordinarily, you are supposed to say, for example, 11% multiplied by 100 naira. This is a waste of time, which is still going to give you 11. So that's what I said. Always remove the percentage. Use the value that you have there. In this case, just put 11 instead of 0.11. It's a waste of time because if you calculate, you're supposed to multiply with 100%. So just come here, put 11 divided by, that's the interest. The yield, according to the question, is 8%. So when you talk about yield is the same thing as rate of return. All right. So which is 0.08. What do you have? 11 divided by 0.08.
137.5.
Thank you very much. So the market value, the unit value of this debenture is 137.5. So that's it. If you want to calculate, you can see examiner says you should calculate unit value, not total value. There is difference between total value and unit value. The value per unit of the debenture is 137 naira 50 kobo. If you have to calculate total value, for example, if I want to calculate total value, total market value of the debenture, all right? If I want to calculate total market value of the debenture, the formula will still remain the same, all right? The formula will remain the same, change, because the interest we have here is per unit of the debt. So if I want to, I need to calculate total interest. Okay, to get the total interest, I would then say, of course, to get the total interest, this is fixed. Let me write out the formula. Fixed interest, because all these little things, you need to understand it, divided by the yield. So the formula remains the same. However, because I want to calculate total value, examiner did not ask you to calculate total value, but I'm just using this one as an example because it was expressly stated in the question that you should calculate unit value of the debenture. Unit value is the value per unit of the debenture. Don't go and be doing total value. So I'm only using this one as an example. All right. So I need to get the fixed interest, the naira terms of the fixed interest. Therefore, I would then say interest rate is 11%. Okay. So because this interest is always based on the nominal value of the debt, the nominal value of the debt. The nominal value is the balance sheet, is the book value, is the balance sheet value. So I would then say 11% multiplied by, I will go back to the question. What's the nominal value of this debenture? The nominal value is 5 million
5 million.
naira. Yes, thank you. So I would then say multiply by 5 million naira. In fact, okay, I will change it. I will change my formula later on so that you understand better. Then divided by the yield is 8%, 0.08. So what's 11% of 5 million naira? 11% of 5 million naira is what? That should be 550,000, right? Is it?
You are
That's
correct,
correct.
sir.
Yeah,
You are correct. You are
550,000.
correct, sir.
So 550,000 divided by 0.08. So what do you have here?
6,875,000.
6,875,000. Okay, thank you very much. So this is the total value. This is total market value of this debenture. This is total market value of this debenture. So if I want to use another formula, market value of debenture will be computed as the nominal value. This, I will give you this particular formula later on when we get to work. Nominal value multiplied by X int price divided by 100 naira. You can see this 100 naira is constant. Of course, it's implied in the question because I told you that is always quoted at 100 naira per unit. So in this case, I would then say the market value of the debt of the debenture equal to nominal value is 5 million naira as given to us, multiplied by the X int price. According to the question, the X int price is 102 naira. divided by 100 naira. So you should have the same amount as 6,875,000. Yes, Minister of Finance, talk to me. Minister of Finance, go ahead.
The 102 we seeing on the screen now was used in the last question. So I'm wondering where it is coming from in this current question.
Which one?
The 102 over 100 naira.
Is in the question. Let me check. Is it
I
not?
think there's a
Oh,
mix-up.
sorry. I wanted my mind was I wanted to use 137.5. My mind went to sorry. Thank you, Jerry. This is 137.5. Thank you. Yes, Mr. Tlisa, talk to me.
Sorry, sir. It's the same thing that I want to call a correction.
Okay. Thank you. It was error of mind, All right then. So that is, as you can see, if examiner asks you to calculate total market value of debt, these are the ways you can do it. But when you're asked to calculate unit value or value per unit, this is the formula this is how you are supposed to do it. This is how you are supposed to do it. All right. So let's move on. So let's talk about redeemable debts. Let's talk about redeemable debts. Or let me see. Okay. We'll come back to that one later. Let's talk about redeemable debt because of time. Okay. Cost of redeemable debts. Okay. Redeemable debts, let me put it down. Redeemable debts is the one in which the company will pay annual fixed interest. We pay annual fixed interest and the principal at the maturity date. Okay, and the principal at the maturity date. Okay. Debts. For this purpose, debts can be redeemed at par, premium, or discounts. Okay, so the par value of debt, of the redeemable debts, is 100 naira, like I mentioned earlier on. So it's 100 naira. So if, for example, let me just put it down. The par value, like I'm trying to say, par value is equal to 100 naira per unit of the debt. If it is premium will be greater than 100 naira. If it is a discount, the value will be less than 100 naira. All right. Okay. So how do you then calculate cost of redeemable debts? The cost of redeemable debts, the cost of redeemable debts is also known as internal rate of return, is also known as internal rate of return or yield to maturity. yield to maturity, YTM. It is calculated. Okay, it can be calculated by assuming two discount rates that will produce two opposing NPV that will produce two opposing NPVs. That is a positive NPV and negative NPV. And then interpolates. And then interpolates into IRR formula as given below. Okay, so you already know this. Internal rate of return, before that, KD, that is internal rate of return, is calculated as lower discount rates plus the NPV of the lower discount rates over NPV of the lower plus NPV of the higher discount rate minus lower discount rate. So this is the formula for calculating the cost of redeemable debt. All right. So what else? Yeah, it's as simple as that. Now, one more important thing you need to take into consideration. Notes. Debt will be redeemable. Debt will be redeemable. If the redemption date redemption or maturity date is given. So you must be given the dates in which the debt will be redeemed in the future. If not, then it has to be calculated as cost of irredeemable debts. Otherwise, it should be calculated. It should be computed as cost of irredeemable debts. Okay, so that's that. So at this point, let's have illustration. Let's have illustration. Okay. Let's see. Let me share my screen with you. Yes, let's solve illustration number 9. Illustration number 9. Somebody should help us read this. Who is helping us? I want to hear your voice. It's like I'm all alone in the class.
Illustration 9.
Thank you.
Every PLC has 10% redeemable debenture in its capital structure. The debenture is currently quoted at 106 naira x interest, and it will be redeemed at par in 5 years' time. Required, calculate the cost of the company's debenture.
Thank you. Yes, that is the question. You have to calculate the cost of the company's debenture. So you need to ask yourself, what kind of debenture is this one? Is it redeemable debenture or irredeemable debenture? The fact that examiner call it a redeemable debenture does not make it a redeemable. A debenture will be redeemable if the maturity date or redemption date is given. In this particular question, you are told that this debenture will be redeemed at par in 5 years' time. That 5 years' time is the redemption date, is the maturity date. So at this point, you can then go ahead and calculate cost of redeemable debenture. Then, how do you compute cost of redeemable debenture? I explained, whenever you want to compute cost of redeemable debt, simply go ahead and calculate internal rate of return by assuming two discount rates that will produce two opposing NPV. That's all you need to do.
Yes, sir.
So in that
Yes,
case,
sir.
let me switch. Go ahead.
I'm lost somewhere. You said a debenture will be redeemable if I didn't get that, sir.
I said the debenture will be redeemable if the redemption date or maturity date is given. Where maturity date is not given, you are going to treat it as cost of irredeemable debt. All right?
Okay.
Yeah. So let's solve this quickly so that we can move to cost of convertible. Okay. So the name, this is solution to illustration 9. This should be page 30, I think. Let me confirm. No, page 29. Still on page 29. Remember what I told you when we started? All these examples, they are just for explanation purpose. This is not the kind of thing the kind of question you are going to meet on the day of your exam. This is to explain the concept. All right. In a bigger question, this is the way it's going to be expressed, but you cannot be given this kind of a short example kind of a question. So, but to express the same way. So the name of the company is Emery PLC. All right, Emery PLC. So I would then say Emery PLC. Examiner is asking you to calculate cost of debenture. You are expected to calculate cost of company's debenture. So we have identified from the question that this is redeemable debenture because you are given the redemption date in 5 years' time. Therefore, I would then say calculating cost of redeemable debenture, KD. I've already explained to you that cost of redeemable debenture will be calculated as internal rate of return. So to calculate the internal rate of return, what are you supposed to do? You assume two discount rates that will produce two opposing NPV. So we'll start from, and I explained to you last time, always start from 10%. When you want to calculate cost of redeemable debt or redeemable preference share, all right, you are supposed to calculate internal rate of return. To do that, you assume two discount rates. And I said that always start from 10%. If 10% is positive, you can increase to 15%. But if 10% is negative, you can reduce to 5%. And the difference between the two discount rates you are going to assume, particularly at this professional level, the difference between the two discount rates should not be more than 5%. If you assume 15%, you can increase to 20%. If you assume 20%, you can increase to 25%. You can't just jump because you are looking for negative NPV. You jump from 20% to 40% just because you are looking for negative NPV. It doesn't work like that. All right, it is not attainable in the market. You can't see such a rate in the market, 100%. It doesn't work like that. So you must know what to do. So starting from 10%, I want to use this 10% to calculate NPV. If my NPV is positive, I will increase to 15%. If my NPV is negative, I will reduce to 5%. So let's start. So I would then say, I'll create a column for year, description of items, cash flow, discount factor, then present value. All right. If I like, I can use two tables. If I like, I can use only one table. I think I've been using one table all the while. Let's use two tables this time around. So at 10%. So year zero, the redemption date of this debenture is in 5 years' time. So that means that the company will pay annual fixed interest from year 1 up to year 5. The fixed interest, of course, the interest is constant. Therefore, I need to calculate annuity factor of year 1 to 5 at 10%. Then at the final year, all right, at the final year, this debenture will be redeemed. How are we going to redeem the debenture? Examiner told us at par. So in year zero, you are going to have current market value. Year 1 to 5, the fixed interest. Then year 5, you are going to redeem it. That's a redemption value. All right. So how much is the current market value of this debenture? Let's go back to the question. You are told that Emery PLC has 10% redeemable debenture. That 10% is the coupon rate, is the interest rate attached to the value. All right. So the debenture is currently quoted at 106 naira x interest. That 106 naira is the market price of the debenture and is already x int. So there's no need for you to convert it to anything. It's already converted to x div. All right, sorry, x int. And it will be redeemed at par in 5 years' time. So if that is the case, I know the interest to be 10%. I know the market price to be 106. So I don't need to be sweating on this. So I will just come here. The market value the market value per unit of the debenture is 106. The interest given to us is 10%. Now, before you put down the interest, you need to confirm from the question if you are given interest rates. Sorry, if you are given tax. So you are not given tax in this question. That's why we are using the 10 directly like that. And you also need to be aware if you are given tax, you must be aware of, you must take into consideration when the tax will be paid. Is the tax going to be paid in the current year or in arrears? I'm going to look for a question to demonstrate that so that you'll be able to see how to, you'll be able to understand how to treat it on the day of your exam if you are given similar question. All right, so let's move on quickly. So we are not adjusting the interest rate because we don't have tax. So that's why we are putting the 10 there. Then redemption value, we are told that it will redeem at par in 10 years' time. At times, the examiner can tell you that it will redeem at a premium or at a discount. But because examiner mentioned that it will be redeemed at par, so then you have to put 100 naira there because debt is always quoted at 100 naira per unit. The par value is 100 naira. So somebody should give me annuity factor of year 1 to 5 at 10%.
3.791.
3.791. Thank you. So 106 multiplied by 1 will give us 106. 10 multiplied by 3.7, that will be 38. Here will be 38. Then somebody should also give me a discount factor of year 5 at 10%.
0.621.
0.621. So please mute. 0.621. All right. So 0.621 multiplied by 100 will give us 62. Therefore, 62 plus 38, that is 100. 100 minus 106. All right, that will give us negative 6. Okay, that will give us negative 6. That means our NPV is equal to 6. Okay. Now, we assume 10%. We had a negative NPV. So let's assume a lower discount rate that will give us a positive NPV. I intentionally changed this so that It's not compulsory that you have to put everything in a table. The two discount rate, you put it in a table. No, you can always separate it. All right. So now, like I said, we assume 10%, we got a negative NPV. You need to reduce your discount rate to get a positive NPV. Therefore, we're assuming 5. Assume 5%. You use this 5% to calculate NPV. Description of items, cash flow, discount factor at 5%, then present value. Year 0, 1 to 5, year 5. Current market value, fixed interest, redemption value. Okay, the market value is 106, interest is 10 naira, redemption value is 100 naira. Somebody should give me annuity factor of year 1 to 5 at 5%.
4.329.
4.329.
4.329. 4.329 multiplied by 10, rounding, will give us 43. Now, discount factor at 5% for year 5 will give us 0.784. Am I correct?
That's correct.
Okay, then. So 0.784 multiplied by 100 will give us 78, rounding. So 78 plus 43, that will give us 121. 121 minus 106 will give us 15 positive. So that's our NPV. So we assume 10%. We had a negative NPV of 10 of 6. Then we reduce to 5%. We have a positive NPV of 15. At this point, we need to interpolate. I would then say cost of redeemable debenture, that is internal rate of return. Yes, Chinonzo, please mute. You and James or Rachel. So equal to A plus NPV of A over NPV of A plus NPV of higher discount rates minus lower discount rates. So we assume 5 and 10. 5% is lower. 5 plus NPV of the 5, 15, divided by 15 plus NPV of higher, 6. Higher discount rate of 10 minus lower discount rate of 5. Therefore, the cost of redeemable debenture is equal to 5 divided by 21. Okay, 15 divided by 21 equal, multiplied by difference between 10 and 5, which is 5, equal, plus 5, equal 8.57. So this is 8.57%. Therefore, the cost of redeemable debenture is approximately 9%. So the cost of redeemable debenture is approximately, okay, %9. So this is how to calculate cost of redeemable debenture or debt. Okay, so let me see. Now, do you have any question for me? If not, let's have another illustration. Let's
So
have
my
another.
question, hello sir, sorry. My question is on a previous solution,
Okay.
value of irredeemable debenture. So when we do the total market value of the debenture, So you times the 11% with
Yeah.
5 million, and I'm thinking why we not also times the current yield, which is the 8% with the 5 million, since we are trying to get the total market value. I was
You
wondering why
don't.
we get
You can't
the
multiply. You can't multiply the yield with the nominal value. You don't do that. The yield, like I said, is a rate of return. The yield is like a rate of return. So you don't multiply with the market value or nominal value. You don't do that. So the only is what you multiply with nominal value is the interest rates. All right. It's only the coupon rate that you multiply with the nominal value to get the fixed interest. So you don't multiply the yield, the rate of return of the debt. You don't multiply with nominal value. All right.
okay, sir.
Yeah. Okay. So let me stop sharing let's have one more example.
Ronald Daily PLC has an 8% redeemable debenture currently quoted at 103 naira as at today, 28th December 2018. The debenture will be redeemed at par at 1st January 2022. The company has a policy of paying debenture interest every 31st December. What is the company's cost of debenture if the company is not liable to pay tax? 2. The company tax rate is 40%.
Thank you very much. So, questions usually come in different dynamics, and you must understand how to interpret question. No matter how big it is, or no matter how small is a question, if you can't interpret it properly, certainly you can't get to the right answer. All right. So this question look very simple, but if you don't get it, if you can't interpret the information you have there, so you may miss the road. All right. So in this particular question, you are required to calculate cost of debt if the company is not liable to pay tax and when tax rate is at 40%. And the examiner has told you it's a redeemable debenture. All right. And the debenture will be redeemed on 1st January 2022. Therefore, what are you supposed to do? First thing first, you must determine the redemption date. Even though it is the 1st January 2022, how many years is this debenture? For how many years? You are told, examiner told you that today is 20th December 2018. 2018 is not part of it because debentures are paid every 31st of December. So 2018 is already gone. So you can't count 20th of December as 1 year. So that one is already gone. So you need to start counting from 2019. In 2019, it's a complete 12 months. 2020 is a complete 12 months. 2021 is a complete 12 months. 2022 is 31st. 2022 is 1st of January. 1st of January is not up to a year. It's not even up to a month. Therefore, the years of this particular debenture is 3 years. So that means this debenture will be redeemed at par in 3 years' time. So you must be able to interpret because some average student can be counting from 2018 to 2022, which is wrong. You have to count 12 months before you can recognize a year. All right. So in solving this question, we have identified that the maturity date, okay, the maturity date is in 3 years' time. We are told that it will redeem in 3 years' time. Sorry, this is maturity. What's wrong with you? Maturity date. Okay, is in 3 years' time. So if that is the case, and you are told that the company is not liable to pay tax, therefore, you need to, of course, it's a redeemable debenture. So you calculate your NPV for positive as well as for negative. Then you keep it on, you calculate your internal rate of return. Then the second one, where there is tax. So if there is tax, the interest of 8% will not be 8%. You need to adjust for tax. 1 minus tax. Tax rate is 40%. 1 minus 40% is 0.6. 0.6 multiplied by 8 will give you 4.8. So it is that 4.8 you are going to use as your fixed interest. So that's what you are supposed to do to solve this particular question. Then we proceed to calculate your internal rate of return. Let's check the solution. So quickly we can, after this, we can move to cost of convertible security. Now, the name of the company is Ronaldoli. All right, the name of this company is Ronaldoli. So we want to calculate cost of debt where the company is not liable to pay tax. So we're assuming 10%. If we assume 10%, we use that 10% to compute NPV. So I will go to the question, what's the current market value of the debenture? According to the question, you are told that the debenture is currently quoted at 103 naira. It's currently quoted at 103 naira. So that is the market price of the debenture. So you need to ask yourself, has the debenture interest been paid or not? Has the company paid debenture interest or not? So examiner told you in the question that the company has a policy of paying debenture interest every 31st of December. Today is 28th of December. So 31st of December has not reached. That means the interest has not been paid, because the interest is usually paid on the 31st of every December. But today is 28th of December, 20th of December. So that means the debenture interest has not been paid. So if the debenture interest has not been paid, you cannot use this 103. It means that 103 is cum-int price. So you need to deduct interest from the 103. The balance you have will then give you X-int price. So let's go and do working for that. All right. So we need to calculate X-int price. The interest expense will be deducted from the cum-int price since interest expense has not been paid. That's the information there. So to now get the X-int price, is simply the cum-int price minus the current interest expense. So the current interest is 8%. The market value, the quoted market price of the debenture is 103. 103 minus 8 will give us 95. So I will then go and put it down in my table. This is the 95 for current value. Sorry, not that one. This is the 95 in year 0. That's the current market value of the debenture. When you multiply with discount factor of 1, we have 95 negative. The next thing I need to do is to calculate the present value of the fixed interest. I want to calculate present value of the fixed interest. So the annual fixed interest, according to the question, is 8%. Interest rate is 8%. So since the company is not liable to pay tax, I will make no adjustment. So I have to put the 8 there. That's why you are seeing this 8 here. So I need to calculate annuity factor of year 1 to 3, because I have identified from the question that the maturity date of this debenture is in 3 years' time. Because from 2019 to 2020, that's 3 years. Sorry, to 2021, that's 3 years. And that's why we are doing year 1 to 3, because the company will pay annual fixed interest from year 1 to year 3 of 8%. So that's the 8% there. Now, the annuity factor of year 1 to 3 at 10% will give you 2.487. If you don't know how to calculate annuity factor, let me know. I can demonstrate that for you quickly. So when you multiply 8 with 2.487, we got 19.9, approximately 20% or so, 20. All right. Then finally, in year 3, there is a redemption value. We are told that this debenture will be redeemed at par. All right. The debenture will be redeemed at par on the 1st of January 2022. So at par means 100 naira. Using 10% discount rate for year 3, and discount factor is 0.751. 0.751. 0.751 multiplied by 100 will give us 75.1. Okay, 75.1. So when you add everything together, first thing first, you need to start from the positive present value. 19.9 plus 75.1. That will give you 95. 95 minus 95 is equal to 0. When you did when you did capital budgeting under performance management, when you were skills level, you must have been taught that internal rate of return is the rate that equates NPV to 0. Any rate that equates the present value of future cash flow to 0, all right, then of course, like I said, any rate, any discount rate that equate the present value of cash inflow and present value of cash outflow to 0, then that rate is your internal rate of return. So we assume 10% and 10% produce 0 NPV. It means that the cost of redeemable debenture for Emery PLC is 10%. So do nothing. There's no need for you to come and put internal rate of return formula again. You have gotten the answer you are looking for, because this 10% is the one that produces 0 NPV. So any rate that you assume that produce 0 NPV is your internal rate of return. And that's what I wrote here. Note, where the assumed discount rate for calculating NPV produce a 0 NPV. Such discount rate is the cost of redeemable debenture, that is internal rate of return. Since IRR is the rate that equates NPV to 0, so we are done with that one. Do nothing. The company's cost of debenture is approximately, is exactly 10%. So that is for that. The second part of the requirement, you have to assume 40% as the company tax rate. So now that you have tax rates of 40%, how is your cost of redeemable debenture going to look like? So in this case, the only difference between this and the first one that we solved is the fact that instead of you to use the 8%, you need to adjust for tax. So this should then be interest multiplied by 1 minus tax. That will give you 4.8. So it is that 4.8 we are going to use to compute your NPV. All right, so let's go to our working. So we need to calculate to get the after-tax cost of debt. After-tax cost of debt is the same thing as post-tax interest or after-tax interest. So debt has a tax deduction. So I don't need to, I've said that severally today. So to get the post-tax is calculated as interest multiplied by 1 minus tax. All right, so interest is 8%. Tax rate is 40%. 1 minus 40% will give us 60%. 60% multiplied by 8 will give us 4.8. So where you have interest, that's the 4.8 you have there. Then the redemption value is 100. The current market value still remains as 95. So at 10%, I want to assume 10%. Oh, okay. Let me start from 5% rather. So I want to assume 5%. I started with 5% discount rate. So all the cash flow remains apart from the interest that we just adjust to 4.8 as a result of tax benefit. So I need to calculate annuity factor from year 1 to 3 at 5%. This is what produced 2.723. 2.723 multiplied by 4.8 will give us 13.1. Okay, 95 multiplied by 1 will give us 95. 100 multiplied by discount factor at year 3. This discount factor for year 3 at 5%, we have 0.864. 0.864 multiplied by 100 will give us 86.4. So to get the NPV, you need to multiply the present value of cash inflow. Okay, you add the two together, 13.1 plus 86.1 minus 95. The difference is 4.5. So we assume 5% and we got a positive NPV of 4.5. So we need to assume a higher discount rate that will produce a negative NPV. And that's why we assume this 10%. So we then use the 10% to compute the NPV. So the cash flow remains as above. So we need to calculate annuity factor of year 1 to 3 at 10%. We got 2.487. Discount factor for year 3 at 10%, we got 0.751. Therefore, you multiply the discount factor with the cash flow. 95 multiplied by 1, 95 negative. 4.8 multiplied by 2.487, 11.9. 100 multiplied by 0.751, 75.1. So you add up the positive present value. Okay, so that will give us I think that's 80, that's 86, that's 87. 87 minus 95. You have to start from the positive. So 87 minus 95 will give us minus 8. So now we assume 5%. We got a positive NPV. We then increase to 10% discount rate. We got a negative NPV of 8. Then we need to put it in the IRR formula. 5 is the lower discount rate. The NPV of the lower discount rate is 4.5. NPV of lower discount rate 4.5. NPV of higher discount rate is 8. So 4.5 plus 8, that will give us 12.8. 4.5 divided by 12.8 multiplied by difference between 10 and 5, then plus 5, that will give us 6.8. 6.8 rounding, that will give us 7%. Therefore, the cost of redeemable debenture for Emery PLC is approximately 7%. So this is how to calculate cost of redeemable debt. Okay, this is how to calculate cost of redeemable debt. Let me know if you have any question for me before we move to cost of convertible securities. Wow, some of you have disappeared. No worries. Yes, any question for me? All right, so if there's no question, let's move on. At this point, let's go to cost of convertible securities. All right. So, okay. Let's talk about cost of convertible securities. Let me just, so that it will be faster, let me stop sharing this. Okay. Cost of convertible securities. What do you mean by convertible securities? Let me put it down for you. Convertible securities are fixed income securities. Okay? Convertible securities are fixed income instruments. Are fixed income instruments, including preference share, shares, bonds, debentures, or loan notes that can be converted to a known number of ordinary shares at a specified future dates. So any securities that can be converted to a number of ordinary shares is what is known as convertible securities. All right, that's what is known as convertible securities. What then is the cost of convertible securities? So the cost of convertible security is the price of the convertible securities, like preference shares, bonds, debenture, or loan notes that can be converted to ordinary share capital. All right. Okay. So how do you then calculate the cost of convertible securities? The cost of convertible security, let me put it down. Calculating the cost of convertible security. I'll be happy if we can finish this today. Then in our next class, we then move to work. We can't do work today because of the time. Okay. So calculating cost of convertible securities. The cost of convertible security will be calculated as the cost of convertible security will be calculated as is calculated. Okay, let me reframe it. Is calculated similar to cost of redeemable debts or preference share, except that instead of using the redemption value, the conversion value will be used. Okay, so the same way you calculate internal rate of return, whenever you want to calculate cost of redeemable debt or preference share, it's the same way you are going to calculate cost of convertible security. The difference is just that instead of you to use redemption value, instead of you to use redemption value, you are expected to use the conversion value. Therefore, the investor, the investors will only convert to ordinary share capital if it is profitable. If it is profitable. If it is not profitable, the investor will not exercise the rights. All right. That is, if the conversion value is higher than the redemption value, the investor will exercise the right. Other than that, they will just allow the debenture, they will just allow the security to lapse, and then at the maturity date, they will redeem it. All right. So in the calculation of cost of convertibles, the higher of one, conversion value, or two, redemption value, should be selected. Okay, should be selected. Now, what do I mean? Whenever you want to calculate cost of convertible securities, the same way you calculate internal rate of return, you are going to have fixed interest, you are going to have redemption value, you calculate market value of the fixed interest, you calculate present value of the redemption value. You add the two together, you less from the current market value, you have your NPV. Now, where you have the redemption value, so if it is convertible securities, instead of you to put redemption value, you are going to put conversion value. You will only do that if the conversion value is higher than the redemption value. But if the redemption value is higher than the conversion value, then, of course, that means the investor will not convert to ordinary share capital. they will just allow the security to mature. Then after that, they will just redeem their principal. All right. So at all time, whenever you want to calculate the cost of convertible securities, just go ahead and calculate internal rate of return. However, in your redemption value, you need to compare the conversion value with the redemption value. Anyone that is higher is the one that will go into the calculation of your NPV. That's basically what you need to do. Then it is also possible, examiner may want you to calculate the market value of convertible securities. Let me show you, or let me tell you what you need to do. Market value of convertible security. Okay. What do you mean by market value of convertible security? The market value of convertible represents the present value of future cash flows. The present value of future cash flows. Let me rewrite that. Of future cash flows. What are the cash flows? That is, depending on whether it is debenture, loan notes, or debenture, loan notes, bonds, or preference share. So if it is debt, then the future value will be the interest or dividend. If it is preference share, interest or dividend. You know, the preference shareholders are entitled to fixed dividend. The debt holders are also entitled to fixed interest. So if you want to calculate the market value of convertible preference share, so the future cash flow that the preference shareholder will then be the fixed dividend and then the principal repayment. And principal repayment, interest or dividend, and principal repayment. Let me put it on the next page. And principal repayments. Okay. Discounted at the yield. Discounted at the yield or cost of the security. Okay, or cost of the security. The yield is the internal rate of return. Okay. So this is how to calculate. Whenever you want to calculate market value, just go ahead and calculate present value. And you know that whenever you want to calculate present value, there are two variables that must be there. One is the fixed interest or fixed dividend, then two, the conversion value. So you calculate present value of the fixed interest or fixed dividend, then two, you calculate the present value of the conversion value. You add the two together, that will give you the market value of the convertible security. So this is basically what you need to know as far as the convertible securities is concerned. So quickly, let's have a short example to demonstrate this. Now, because of the limited time that we have, I don't want to delay you beyond the normal time. Let me use Golden Book to explain this. Let's use the examples in the Golden Book so that will be faster. Let me stop sharing. Okay. So all right. Let's have this example number one. Let's have example number one, so that in our next class, we'll start afresh. And we can start on a clean note on to discuss weighted average cost of capital. Yes. So he's helping us to read quickly. Let me look for one of you. Augusta, I've not heard your voice.
Okay. Can I read?
Oh, I was even thinking Augusta is a lady.
Okay.
Yeah, go ahead. Thank you.
Oh, I'm not Augusta, am I for? Okay.
Oh, no, I said Augusta. I want Augusta to read.
Okay.
Thank you, Ifua. Did I pronounce your name very well?
Yes, sir.
Afua.
Yes, sir. You did, sir. You did.
Okay, thank you. Yeah, Augusta, read.
Okay, sir. Lacazette PLC has in issue a convertible debenture with a coupon rate of 12%. Each 100 units may be converted to 20 ordinary shares at any time until the expiry date, and any remaining debenture will be redeemed at 100 naira. The debenture has 5 years to run. Investors will normally require a rate of return of 8% per annum on the 5 years debt securities. Should the investor convert if the current share price is A, 4 naira, B, 5 naira, C, 6 naira?
Thank you very much, Augusta. Yes, quickly, without wasting time, look at this question. The requirement says that, please mute. The requirement says that should investor convert if the current share price is 4 naira, 5 naira, 6 naira. I told you earlier when I was giving you the note that investor will only convert to the known number of ordinary shares if it is profitable. So if it is not profitable, then they are going to wait until the maturity date when they are going to redeem the security. And then when you talk about conversion, all right, you are supposed to compare the conversion value with your redemption value to know whether it is profitable. If the conversion value is higher than the redemption value, it means it is profitable. But if not, it is not profitable, then investors will not convert. So in this particular question, you want to know whether the investor should convert at the current share price of 4 naira, 5 naira, and then 6 naira. So what are you supposed to do? What are you supposed to, before you can compare, you need to have what is the current market value? What is the value if I want to redeem this debenture? If I want to redeem the debenture in the next 5 years, what is the value? What is the value per unit of the debenture? So if I want to, that will be the redemption value. Then if I want to convert at 4 naira, what is the conversion value? If I want to convert at 5 naira, what's the conversion value? If I want to convert at 6 naira, what's the conversion value? Therefore, I need to compare the redemption value with the conversion value at 4 naira, 5 naira, and 6 naira. At any price that the conversion value is higher than the redemption value, that is the price at which the investor should convert. Now, first thing first, like I said, you need to calculate the redemption value. How do you calculate the redemption value? Simply go ahead and calculate internal rate of return calculate the present value, because I explained to you that market value of a debenture or market value of debt represents the present value of future cash flows. The future cash flow will represent the fixed interest as well as the principal repayment discounted at the yield of the debt. So in this particular question, the coupon rate, the interest rate is 12%. Like I said, when you talk about coupon rate, it's the same thing as interest rate. So the interest rate is 12%, and you are told that this will be redeemed at 100 naira. So that's the redemption value. Therefore, I need to, in this question, we don't have tax rates. Therefore, I will calculate the present value of fixed interest. This fixed interest is equal to 12. Then I will calculate the present value of the redemption value. Okay? The redemption value, examiner told us, is at par, which is 100 naira. So whatever, I will discount this. I'll multiply with discount factor, I will get the present value. I will add the present value together. So that present value will give me the the current market value of the debenture. We give me the current market value of the debenture if the company wants to redeem it. All right. So that is for that. I'll keep it on one side. Then I need to go and calculate the conversion value at 4 naira, 5 naira, and 20 naira. So examiner told us that each 100 units may be converted to 20 ordinary shares. So I want to this is the conversion price. Conversion price is 4 naira multiplied by 20. Value will then be 80 naira. 20 shares multiplied by 5, value will be equal to 100 naira. 20 multiplied by 6, value will be equal to 120. So I will now compare 80, 100, 120 with whatever I have here as the redemption value, the present value, if the company wants to redeem it. So that's what you need to do. Anyone that is higher is what you are going to select. So let's quickly check out the example. The name of the company is Lacassette. Is there any information? I've already explained all of this, so you can just go through that. Now, okay, if the conversion value is, so I've already said that already. So let's move on. Now, calculation of current market value, that is present value. Remember, market value of the debenture, I've already explained this also, so don't need to waste time. Now, I want to calculate the present value. So to do this, I will go to the question, I will pick the interest. The interest given to us in the question is the coupon rate is 12%. So that's the 12%, that's the 12 you are seeing here. Like I said, always ignore the percentage behind the interest rates because debt is always quoted at 100 naira per unit. Then the next thing I need to do is to determine the present value of the conversion value. We are told that this, of the redemption value. Now, we are told that the debenture will be redeemed at 100 naira. At 100 naira means at par, and that's the 100 naira here. So I will then go back to the question, what's the coupon rate, what's the yield? The yield is the same thing as rate of return or internal rate of return. So we are given rate of return of 8%. It means that this 8% is the yield. Therefore, I need to calculate annuity factor of year 1 to 5 because the maturity date of this debenture, we are told that in 5 years debt, it's a 5 years debt. All right, it's a 5 years debt. So I need to calculate year 1 to 5. Annuity factor of year 1 to 5 at 8% is 3.993. 3.993 multiplied by 12 will give us 47.9. Then, if the company wants to redeem the debenture at par, which is 100 naira, discount factor at 8% for year 5 is 0.681. 0.681 multiplied by 100 will give us 68.1. 68.1 plus 47.9, when you add the two together, we got 116.0. That's 116 naira per unit. So the current market value per unit of this debenture is 116 naira. So if this company wants to redeem the debenture, so the market value per unit is 116 naira. So examiner is now asking you to advise whether investors should convert at 4 naira, 5 naira, or 6 naira. So to do that, now that I've calculated the current market value to be 116, I need to calculate the conversion value. To get the conversion value, you multiply the conversion of the share price with the number of shares. Because examiner told you in the question that shares, the company can, each 100 naira unit may be converted to 20 ordinary shares at any time until the expiry date. All right, so 20 number of shares. So 20 multiplied by 4, 20 multiplied by 5, 20 multiplied by 6. And that's what we have here. We got 80 naira for 4 naira price. We got 100 naira for 5 naira price. We got 6 naira so we got 120 naira for 6 naira share price. So when you look at the three conversion value, of course, examiner is asked, you need to compare all these values, 80 naira, 100 naira, 120 naira, you compare it with the current market value of 116. Anyone that is higher than the current market value, that is the price at which the investor should convert. Therefore, you can see 120 naira, 80 naira, 100 naira is lower than 116. So investor will not be motivated to convert at 4 naira and as well as at 5 naira, because the conversion value of 80 naira and 100 naira is lower than the current market value. So only price of 6 naira, which produced the conversion value of 120 naira, is greater than the current market value. Therefore, investors should convert at 6 naira. So look at my explanation here also. The investor should convert at the share price of 6 naira because it is the price at which total conversion value of 120 naira is greater than the current market value of 116. All right. So that is basically what you need to do. That's what you need to do. Let me know if you have any question for me so that I can quickly do cost of this. This particular question relates to the value. Then let's talk about how to calculate the cost of convertible security. Can you quickly tell me why? No, sir, you are I'm fast. Oh, sorry. Sorry, it's because we are running out of time. So there's no worries. When you listen to the video, you see that I'm not fast. Sorry about that. So I will slow down. I will slow down. Let's move to the last one. So let me know if you have any question for me on this particular question. Otherwise, let's have one more that has to do with cost. The question we just solved relate to how to calculate market value of convertible security. So it has nothing to do with cost. So let's solve a question that relates to how to calculate cost of convertible. All right. Sorry, Ifua, once again. I didn't know that was fast. Maybe because I was looking at the time that, okay, it's almost end of the class. All right, so let's have one more. Let's solve this example number 2 here. You have the same question in your material. So somebody should help us. Okay. Uju, are you there? Uju? Are you still on, or you are represented by proxy? Uju? Okay. Let me look for another person. Coyote, can you read for us?
Yes, sir.
Okay, please go ahead.
Singapore Limited has 10% convertible debentures with a current market value of 106 naira. An interest payment was made recently. The debenture will be converted to equity shares in 4 years' time at the rate of 40 shares per 100 naira of debentures. The shares are expected to have a market value of 3 naira 50 kobo each as at that time. What is the cost of capital to the company for the convertible debentures when company tax rate is 40%? And assume that tax payment occur in the same year that the interest payment arises.
Yeah, thank you very much, Sake. Yes, that is the question. Somebody is sending me. What page is this question in our study? Is there? Just look at, scroll down, you will see the question there. All right. I don't know the exact people. I will check for you. Let's first of all solve this particular. I will show you where you have it there. Or let me quickly check. Let me quickly check. It's asking what page. That should be, yes, that's illustration 14 and 15. Illustration 14 and 15. That's the page. Sorry, page 32. Page 32. Olumide. Is that Olumide? Olamide rather. Olamide is on page 32.
32, sir. Yeah, I've seen it, sir. I've seen it.
Okay.
All right. Thank you, sir.
You're welcome. So let's go ahead. Let's solve the question quickly. Now, examiner is asking us, what is the cost of capital to the company for the convertible debenture when company tax rate is 40%, and assume that Tax payment occurs in the same year that the interest payment arises. So here, examiner is asking you to calculate cost of capital to the company for the convertible debenture. This has nothing to do with value. All right, that's nothing to do with market value. You have to calculate cost of convertible debenture. How do you compute cost of the convertible debenture? I told you the cost of convertible debenture should be calculated as internal rate of return. The only difference is that just the same way you calculate cost of redeemable debt or cost of redeemable preference share is the same way you are going to calculate cost of convertible security. The only difference is just that instead of you to use redemption value, you are going to use conversion value. All right. So that's what you need to do. Quickly, let's go through it together. Notes. Let's check out what I wrote here. The cost of convertible debt will be calculated same as the cost of redeemable debt, except that conversion value will replace redemption value if conversion value is higher. In the case of Singapore, the conversion value of 140 naira, is higher than the redemption value of 100. So that is basically that. Now, before you begin to solve, you need to go and work out. You need to go and do your working for conversion value. You then compare with the redemption value. Whichever of the two that is higher is what you are going to select. All right. So in the working, so we need to calculate conversion value. According to the question, you are told that the debenture will be converted to equity shares in 4 years' time at a rate of 40 shares per 100 naira of debenture. The shares are expected to have a market value of 3 naira 50 kobo each as at that time. So the number of shares you are going to convert, the number of ordinary shares you are going to convert to debenture is 40 shares. So 40 multiplied by the market price. The market value is 3 naira 50 kobo. Therefore, 40 multiplied by 3.5 will give us 140 naira. So conversion value is 140 naira. Now, you keep it on one side. That's the conversion value. What then is the redemption value? You can see in this question, you are told that, of course, per 100 naira of the debenture. So because the par value is not expressly stated, but you should know that it will be at a par. It's going to be at par, and at par means at 100 naira. So you compare the 140 conversion value with the par value of 100 naira, with the redemption value of 100 naira. 140 is higher than 100 naira. Therefore, the investors will exercise the rights. They are going to exercise their rights, and that's why you are seeing 140 here. When you look at my workings, okay, you see here is the conversion value. We've calculated conversion value to be 140 naira. So you then need to select the higher of the conversion value of 140 or the lower. I mean, you compare with the redemption value of 100 naira. Conversion value is higher. That's why we are selecting conversion value. So I will then come here. I'll put it there. That's the 140 you are seeing. You can see all the one we have been calculating since. Under preference share and also cost of debt. We have been using redemption value here. So you can see because conversion value is higher than redemption value, that's why we are using conversion value. But if redemption value is higher than conversion, it is redemption value you are going to use. So that's why you are seeing here that 140 is higher than 100. That's why we are using the conversion value. The current market value, according to the question, is 106 naira. Okay, the current market value is 106. We are told that interest payment was made recently. So it means that 106 naira is already X-int price. So, and that's why you see I didn't make any adjustment. That's the 106. The fixed interest. The interest is the coupon rate on this convertible security, all right, which is given. We are told that Singapore Limited has 10% convertible debenture. That 10% is the coupon rate, all right? So if there is tax, we need to adjust for tax. You cannot just use the 10 like that. Therefore, examiner has given to us tax rate to be 40%. So 1 minus 40% will give us 60%. 60% of 10 will give us 6. That's why you are seeing 6 here. That's why you are seeing this 6 here. Okay? Therefore, I need to calculate. Remember, you want to calculate internal rate of return. So you have to assume two discount rate that will produce two opposing NPV. I started with 15%. The discount factor, the annuity factor of year 1 to 4 at 15% is 2.885. 2.885 multiplied by 6 will give us 17. Okay? 106 multiplied by 1 will give us 106. Discount factor at year 4. Discount factor for year 4 at 15% will give us 0.572. 0.572 multiplied by conversion value in year 4 of 140 will give us 80 naira. So 80 plus 17 will give us 97. 97 minus 106 will give us minus 9. Therefore, we assume 15%. We got a negative NPV of 9. So we need to assume a lower discount rate that will produce a positive NPV. And that's why we assume 10% here. So the cash flow still remains the same as 106 as current market value, 6 naira as the fixed interest, then conversion value as 140. So I need to calculate annuity factor of year 1 to 4 at 10%. When you put that in your calculator, you get 3.170. Discount factor for year 4 at 10% will give us 0.683. So 106 multiplied by 106. 6 multiplied by 3.170, we got 19. 140 multiplied by 0.683, we got 96. 96 plus 19 will give us 115. 115 minus 106, we have 9. So this is positive NPV. So we assume 10%. We got a negative NPV of 9. We assume another 10%. We assume 15% initially. We got minus 9 NPV. Then we reduce to 10%. We got a positive 9 naira NPV. So we need to put everything in the formula of internal rate of return to get the convertible debenture. So of course, you're already familiar with this formula. So we assume 10%. We also assume 15%. 10% is lower. That's the lower discount rate. NPV of the lower discount rate is 9. NPV of higher discount rate is also 9. 9 divided by 18, that will give us 50%. So 50% of difference between 15 and 10, which is 2.5. 2.5 plus 10, that will give us the 12.5. Therefore, the cost of the convertible securities for Singapore Limited is approximately 13%. So this is how to calculate cost of convertible securities. All right, this is how to calculate cost of convertible securities. So if you don't understand how to calculate annuity factor, this is the formula. I think I demonstrated this in our last class. All right. So at 10%, we got this. At 15%, we got this. And then the after-tax cost of debt. So this is how we arrive at the 6 that we have been using as interest. So I think that's the end of the question. That's the end of the question. So let me know if you have any question for me before we close the class. The time is fast spent. Some of us have disappeared in the class, which is understandable. All right. So let me know if you have any question for me so that we can close the class for today.
Sir.
Yes, talk to me.
Okay, the last time we met, you said you will show us how to calculate the growth rates. You know,
the what?
The growth rate, as in how we can use our calculator, our scientific calculator to calculate it straight. You said you will share it with us, and you've not done that, sir.
Okay. I understand. I will try. I will share with you. Okay. No worries. I will try and do that. But I demonstrated for you how to I said that if you don't know how to use second function in your calculator, that's what I converted to SOD. All right. It's
Yes,
just mathematics. So just
So
in case
please
that
help
one
us to
is
share, sir.
that one has more, the one that I converted, it has more clarity than if you are not sure of your of how to use that, how to use second function of your calculator. Now that this one is very clear. But that notwithstanding, like I said, I will do that. Actually, I forgot. I forgot. You know, I'm a man of several, no worries. I will get back to you. All right. I will get back to you.
Okay, sir.
Okay.
Thank you, sir.
Yeah. So any other questions so that we can close the class? Yes.
Yes, sir.
Okay. Talk to me.
Yeah, so please I don't want you to scrub to the question a little bit. I want to ask a question. Okay, yeah.
Okay.
Okay, yeah. I discovered, I don't know whether it's just my own what's it called now? My own SFM, the one they shared. I
Okay.
discovered that from the question we just solved, what we solved, we're having 40 share per 100
Yeah.
naira to venture, but I'm having 4 and 10. I don't know.
It's the same thing. So that 4 and 10, just say 4 multiplied by 10 multiplied by 3 naira 50 kobo. All right.
Okay.
You get the same
Okay.
thing as a 140.
Okay.
Yeah. Okay. So any other question?
So, sir, thank you very much, sir, for this session. So, my question
Yeah.
is around the questions. The question we solved before this question, I'm not
Okay.
sure is actually in this text.
Like I said, is there. Illustration number 14 and 15 is there.
14 and 15.
Yeah. Like I said, PLC as well as the Singapore Limited.
Okay.
Both of them are there.
Page 32 is on page.
Okay.
Is
Page
it our
32.
study text, really?
Yes,
Yes,
page
yes, in
32.
our text. Yeah.
Okay. All right.
Yeah.
Because I'm seeing page 71 here.
Page 70. No. Page 71, it should be something else. It should be another topic.
Okay. I'm seeing 71 on this on the top of this example one, and I'm like,
Okay, no. This one is different from this is the Golden Book. This is Strategic Financial Management Golden Book. It's a textbook. You can see this one is showing about 765 pages.
aha. How are
When
we
we look
getting
at
this?
this one is a textbook.
How we can get this? This
Of course,
textbook.
I think I shared it in your group, in your SFM group. I will share it again. You can always click the link, go to
Okay.
the opt-in page, you read about the content and all of that. It's a textbook, a very highly simplified material on strategic financial management. This
Okay.
particular material will help you as far as SFM is concerned. Anything, any topic, just mention it. You are good to go. Just take your time, master the concepts, and whichever one, irrespective of the topic, just go in there, learn it step by step, and you are good. You are good. It's a very solid material. I will talk again on the group so that you can, if you need a copy, you can always get it.
Thank you very
All right.
much. I appreciate that. Thank you, sir.
You are welcome. You are welcome. Yes, any other question for me so that I can close the class for the day? Okay. So in the absence of no further question, I want to say thank you for your patience and understanding. In our next class, by the grace of God, we are going to do weighted average cost of capital. Of course, on that day, we cannot complete work because I have to solve different illustrations for us to be able to really understand the concept. All what we have been discussing from the beginning of this class, okay, from the beginning, I think this is the third, is it third or fourth? No, this is the third lecture we are going to have on cost of capital. All right, so all what we have discussed so far under cost of equity, cost of preference share, cost of debt, it is time for us to put it into practice. A one question that will cover everything. All right, that is what we are going to do under WAP. You will recall when we started on the day one, I mentioned to you that whenever you want to calculate traditional weighted average cost of capital, there are 4 procedures you are expected to carry out. 1 is to calculate cost of equity. 2, you calculate cost of preference share. 3, you estimate cost of debt. Then 4, you compute weighted average cost of capital. So far, we have explained, we have dissected cost of equity, cost of preference share, as well as the cost of debt. So in our next class, we are moving to the 4th step, which is to calculate weighted average cost of capital. Once we are done with weighted average, we need 2 periods for us to be able to do justice to that. But if you cooperate with me, at least I should be able to solve like 4 different illustrations, the bigger questions. So if you cooperate with me, we're able to solve that 4 within 2 hours or 2.5 hours available. Then in that case, that means in our next class, after next week, we are going to be doing project specific work. So, but if not, then we continue with work. All right then. So thank you everyone. I will see you next week by the grace of God. Bye-bye.
Thank you. Restful evening.
You are welcome. Bye.
All right, good night, sir. Thank you, sir.
Good night. Take care. Bye.